Damon Bonser is the co-founder and CEO of the British Design Fund, working with startups across the UK, supporting innovative and ambitious early-stage hardware companies to market since 2017.
Businesses we invest in, if we were to not invest in them, the world would be a little bit worse off.
Before Damon was steering the ship at the British Design Fund, he dived headfirst into his own product businesses.
Early mid-20s, took myself off to China, sort of looking for opportunities to play in the sort of product space.
Which sourced, designed and sold homewares, gifting and fashion accessories.
But it was time to come back, entering a different stage in my life, let's say.
Through this venture, Damon learned the ropes, faced challenges and came out with the purpose to support and scale up of UK-based startups.
We're hands-on, we're operators, right? We never set this thing up as a bunch of kind of private equity guys looking for somewhere to put our spare cash. We set this up because we've built product businesses. We know the pain. And
in today's video, Damon shares his insights from how he started the British Design Fund.
Because it's so fundamental to what you're doing. It's so groundbreaking.
Yeah.
Why wouldn't you want this?
Yeah. What investors look for in startups, and we learn what it takes for a tech startup to be successful in scaling up their company.
In the sense that if you get it wrong in the first year or two as a hardware startup, it's invariably game over.
All good? Yeah. We'll roll out. Okay, great. Damon, hello.
Lovely to see you.
Welcome to our Secrets of Scale studio here in Victoria. Thanks for coming, for dropping by. You're CEO and founder of the British Design Fund. Just tell us a little bit about your background and kind of, how that obviously led you into becoming CEO and founder of the British Design Fund.
Early mid-20s, took myself off to China, sort of looking for opportunities to play in the sort of product space. Started off with a sort of distribution company, so a bit of trading, no IP in there. Not a huge amount of value add, but basically being the middle guy. Then built up a business within the consumer product space, bit more IP, our own brand. Then we sold that brand about sort of 9 years or so ago. But basically brought myself back to the UK for a few different things. And we sold the brand, started a family, wanted to kind of base myself back here. And had a really good time out in China, really enjoyed building products out there. But it was time to come back, entering a different stage in my life, let's say. And the idea for the fund came about when I was back at the Design Council, which is an institution we'd worked with over the years. They've been really good to some of my previous companies, giving us some grants and support. I was in there sort of talking to them about, understand your market, how you're going to get to market, all these sort of really interesting things, which they're very grateful for. But a lot of these startups, who were all hardware startups, would come back and say, "Damon, it's really, really helpful." Problem is, no one will invest in this. Like, we can't have a sensible conversation with an investor because we've got hardware. Fundamentally, our technology, our solution, whatever it is, might be in a really attractive market, but because we're basically pre-revenue, if we're talking TRL, these guys were early, not even TRL 4 or 5, they were sort of back of an envelope type thing. Yeah. But they just couldn't have a sensible conversation with an investor. So that's kind of where the penny dropped, looking around and seeing who out there really gets product, really gets hardware, really gets the manufacturing piece. And basically, after a couple of years, kind of, we all agreed there really wasn't anyone out there not playing in the early stage. The key thing is, people, everyone knows investors get very nervous with early stage. It takes a certain type of investor to take those risks. But what we find is if you combine that early stage with hardware, then a majority of investors are really uncomfortable playing there. So that's where it all came from.
What would you say is your mission, at the BDF?
Yeah. So what we, I guess, call our thesis in terms of a fund. So we look for early stage, purpose-led UK technology businesses that, in order for them to get to market and get revenues, it will require them to engage with manufacturing. But importantly, we are an investor that understands hardware. So we come with realistic expectations, and those are reasonable as we sort of deploy those funds. Because I think what we're finding when we went out to market and spoke to potential investees, so places where we could put cash, they came to us and said, well, we've got two problems that kept coming up. One was that they just couldn't find an investor. Yeah. The doors were constantly being closed in their face. And as soon as they mentioned hardware, that was it. And then the other problem, and that was the larger of the two problems, the second problem was that they would find an investor, but had completely unrealistic expectations. So kind of, you know, so we sort of say, look, we're the investor that understands these things. You might have an optimistic business plan. We might calm it down a little bit and say, look, maybe a couple more iterations there. You know, it's a complicated product, it's very regulated, might take a bit longer than you think to get there. But fundamentally, it's, you know, if you look across all of our portfolio, the thing that really sets us apart is every single business has some element of manufacturing and hardware. There's some IP in those businesses as well. We look for businesses that have some patent protection. They're all purpose led. So that for us, that's evolving into a bit of a social impact, social purpose, I guess. So how we assess that is that we say each of the businesses we invest in, if we were to not invest in them, the world would be a little bit worse off. So we're kind of looking for groundbreaking. We're not necessarily businesses that are making a small incremental change. We want them to be quite groundbreaking. We want to feel that if we are going to back this business, and that will hopefully reduce in a result in fairly large scale manufacturing, we want to feel comfortable that actually the world's going to be better off for that. But that's kind of what we set out. And as with all these things, you know, we're up to now, we're deploying our fifth fund now, and we're launching a scale up fund, and we're, you know, continuing to grow. You know, the thesis has evolved, like our mission has changed over the last sort of 3 or 4 years. There's a lot of it's remained true. I mean, the purpose piece is probably the main thing that came in at fund 2 and 3. You know, we started to look back at the portfolio and say, look, all of these businesses, you know, we don't use the word impact, but a lot of people are looking and saying, oh, they're all impact hardware.
I guess a case of, you know, as you have more investments over the years and more success stories, then that of course in itself creates more awareness and therefore hopefully inspires more people to get involved with this, because they know that help and that expertise is there, right?
Yeah. And that works on both sides. So for our investees and our investors, so from the companies coming through that we put money into, that helps us, you know, if they see the kind of support that we're giving the companies. You know, we're hands-on, we're operators, right? You know, we never set this thing up as a bunch of kind of private equity guys looking for somewhere to put our spare cash. You know, we set this up because we've built product businesses. We know the pain, and that's why we set it up. So we are operators. We get involved with the companies. You know, we really do, and that does work for the deal flow side of things, because word does get about. You know, people know if you're doing a good job. We're now up to we must be up to sort of approaching 30 companies. And if anyone comes in new and asks about our kind of support program and our mentoring, I always say, take a look at our portfolio, pick any of them you want. I'll connect you and talk to you, because it's so valuable what we provide to them. But then on the flip side, for investors, also the word gets out, and that's, you know, that is the success of the portfolio. That's a bit more on the commercials. That's how we're judged. You know, you don't necessarily see the investees come through looking at your performance record, but investors certainly do. You know, looking at what your rates of return and how's it performing, how many failures have you had? Thankfully, not many so far. But yeah, so we're doing good on both sides so far. Yeah.
Cool. So just more on the actual investing side of things. I mean, what is your kind of process or key things that you're looking at when you're obviously assessing, you know, to invest?
So there's a few. The headlines, I mean, the things, the red flags that will get rid of your application when it goes through the process will be hardware, IP, and, you know, obviously strength of team. That's where it's a little bit harder. You can't assess that on a kind of application form necessarily, but purpose is a big part. You know, so we really have to feel there's something groundbreaking that this team is trying to achieve, an important need that has scalability. You know, ideally global level. But it's really shrouded in purpose. You know, it's not a nice to have as such. It's an essential one, and all of that stuff. If you think about it, that purpose led, whatever you want to call it, you know, social purpose, impact, or purpose led, it really helps understand that route to market as well. You know, it's because suddenly your marketing and your sales activities become less about convincing an audience. It's about just actually raising awareness. Yeah, because it's so fundamental to what you're doing. It's so groundbreaking. Yeah. Why wouldn't you want this? Yeah. And we that's what we look for.
I mean, as a funder, as an investor, what are your challenges?
So always finding good deals and finding cash to invest. So we're always fundraising and we're always deploying. That's the two modes we're always in. And I think so long as you as long as you deliver on what you say you're going to do, and your portfolio, behaves itself and shows the returns that you want it to, you'll get your investors. And I think so long as there are innovators in the UK coming up with groundbreaking ideas, and then I suppose, why would that suddenly stop? And you start to look a little bit more towards government and the support and the grants, which this country is really good for. But that whole ecosystem we got, it's working, And with the hardware piece, our point of difference being it's just hardware technologies or technologies that require hardware to go to market. Those are the ones we're backing. But I'd say things are gradually changing. Certainly this onshoring, the whole process of certain elements of production coming back to Europe, to the UK, people are starting to see it. Investors are seeing it. They're becoming a little bit more familiar that actually some of their portfolio might have hardware in it, and that hardware doesn't necessarily need to be something that's 1,000 odd miles away. It's on their doorstep. So that's helping. But also in the UK in general, some of the things we have going on that help us from a deal flow point of view, so encouraging these entrepreneurs to take the risk. The money's still there for that innovation, for important innovations addressing big problems. You can get non-dilutive funding. That is a real game changer. The tax relief you get from IP-rich businesses, on your kind of corporation tax or your R&D tax credits, but also the SEI, CIS piece, de-risks it for investors, which again encourages those entrepreneurs to take a risk because they feel they can have a conversation with an investor and say, well, we are SEIS eligible. You're de-risking by 50% straight away. So there's a few good things we've got still going for us in the UK.
Of course.
So a lot of our businesses won't have necessarily huge levels of stock risk to them. So a lot of what we do is B2B. So that does skew our profile a little bit. We don't have so much, if you think of a very typical consumer business, you have this vision of a warehouse full of speculative stock, makes all funders, bank managers and investors a little bit nervous. So our experience is a bit more on the B2B, where it's typically lower production, commission made to order, that side of things. It's a little bit more typical of our profile. But I'd say even on the consumer stuff, the landscape's changing. The way things are made is changing. If you just look at 3D printing, so many of our businesses have 3D printing as part of the final product, and at some point they might tool up some of the parts. At some point, there's just no need to. There are ways to run a business now much, much lower stock than when I was doing this 20 years ago. Any startup's difficult. Any startup's super hard. And even, pure software plays, like all the SaaS stuff we see, there's not many of those that really exit in 5-6 years. Most of them, it always takes a bit longer. We're entrepreneurs always, always super enthusiastic and optimistic, but typically you are looking realistically, probably let's maybe say 7 to 10 years for all kinds of startups to get a good exit on them. But with the hardware as hard thing, I think what I see that the biggest point of difference is in those first couple of years where we're really active and where we put a lot of resource into these companies. It's a cash burn difference in the sense that if you get it wrong in the first year or two as a hardware startup, it's invariably game over. If you sink 200 or 300 grand into a tool, you start producing product and you realize there's some misalignment with your customer, with your market, you'd be lucky to survive that. Whereas if I think in a very sort of simplistic term about a typical software only startup, to a certain degree, they can rewrite some of that code and get it out there and correct it all. But it's a little bit harder to pivot, let's say, as a hardware. So that's why we're really on top of our companies certainly for the first 1 to 2 years. It's so vital that they don't trip up. And then beyond that, they do, obviously, but all businesses have different cash profiles and you could argue a sort of software owner's got such a big, often, again, we're sort of stereotyping slightly, but they have a big sort of marketing spend, big digital ad spends. And again, there's it's all different profiles with a lot of the product stuff. Where your cash goes is often into some form of asset, IP, tooling, things that can be realized, let's say, if things start heading a bit south.
I mean, when it comes to mentorship, first of all, did you have a mentor? Tell us about that. I did myself. I interviewed him, which was great, as part of this. How do you find a good mentor?
Yeah, so it's tough. So I didn't have a mentor in my early years. Now with the fund, I have a coach. My chairman insisted on it. He said, look, we spend all our time supporting these companies. Who's supporting you? How do you? I was like, so I have a coach myself. But there's always a list of things you don't know. So but we obviously help on that. There's the sort of things you don't know, but it's always the stuff that you didn't know you needed to know that the mentors can say, look, I've been on this journey before. We've seen it go wrong. You're showing some of the signs that can be a bit of a be a bit of a nail in the coffin. So let's take action now. Sort of 6 to 9 months ahead of it even escalating. But your question was, how do you find a mentor? I mean, look, that's as an entrepreneur, like an early stage startup founder entrepreneur going at this for the first time. If there isn't an if you don't fall into an organization like ours, for instance, where you get the mentors provided, you've got to get out. You've got to put yourself out there. You can't shut yourself away in a studio. You've got to get out. You've got to do a bit of networking. You've got to sell your business and the dream and the idea. You've got to get people like you'll suddenly start to attract people like advisors. You'll see people at events, at networking events, at kind of maker spaces. Surround yourself with these people, and you will pick them up. People will. They'll spot you as well. If you're out there selling your business, people will, and assuming it's something that's, that's got some legs to it, people will spot it, and you will attract people that will come on as advisors, and they might invest in you as well, but they might come in advisors with no cost. You might then start to find people that, there's a lot of people out there that have made a huge amount of money that are maybe in slightly more corporate roles that don't often get asked the simple question, mate, do you mind? I really appreciate a day every couple of months to just, well, not even a day, an hour every couple of months to just sit and talk to what I'm doing. Would you? Some of them are so flattered if you go and ask them.
Yeah, you'll be surprised, isn't there? And
the worst thing they'll say is no. If you don't.
Yeah. Just tell me a little bit about how important you think it is to have a co-founder and finding good people, certainly early days.
From an investor community, typically you'll be looked upon slightly more favourably if you've got a co-founder.
Yeah.
If you think just logically, I've met some tech investors in the past who have, you're looking at the valuations they're coming in at, and for us it just blows our mind. I was like, how on earth can you value that? And well, look, it's 3 times what it would be if it's just one founder. Like that's the back of envelope where they'd value it. Right, we'll give them 2 million quid pre-money per founder, sort of thing. So be aware that from an investor's point of view, it does in reality de-risk it. And it's nice if it's complementary. So we do look for it, but it doesn't mean we don't back single founders, because then it might be a single founder that's already bringing on a team and willing to relinquish responsibility. I think that's the concern, is if you've got a single founder that just holds on to everything, that's a concern. If you've got a team around you, if you've already got, if you've got some co-founders, you're probably not that kind of person. Yeah, but it is tricky. It's worth being aware of. And I can guarantee there'll be a discussion point at committee level and with the board around, it is risky. You're dealing with you're fundamentally dealing with one person, if they lose the kind of the appetite for it, you're in trouble.
Yeah. After investing, what is the biggest mistakes that you see when these startups want to scale? Because obviously they've got some funding, right?
Yeah. Taking too long. Yeah. So really, it's just you can't put strap enough rockets to them. Taking too long is definitely the biggest risk, because it comes back to that point I made earlier, and everyone has different views about IP and patents with early stage businesses. But in those first year or two, just get to market. That is your biggest defensible position. Start building your brand. Just get it, and it's such a big traction point. We specialize in taking them from pre-revenue to revenue, so it's such a big traction point. The valuation jumps up. You can raise some cash. It's a major milestone on that kind of roadmap slide. That's the big one. That's for us. That's a really big one. You've gone from a great idea, a little bit of customer feedback and a bit of interest, and maybe a little letter of intent here and there, but actually getting repeated recurring revenues, building up your monthly run rates, all this sort of stuff. It's such a major proof point. So every now and again one will come through that's got early revenues. So I suppose that sometimes the support's a little bit different for those, but the majority of them, if we can just get you trading, and ideally within 12 months, we have we set a pretty high bar for ourselves. Yeah.
You must have seen a few pitches in your time, and pitch decks. What in your eyes, what makes a good pitch deck? The good ones, you kind of get that feeling, right?
Straightforward. You've got to make an assumption that the person reading this pitch deck isn't an expert. Yeah. Right, number one. So, and if you can't explain your business simply and how you're going to make money simply, then you're going to struggle. You're going to struggle to get customers. You struggle to get investors. So, keep it nice and simple. And ideally, for the person reading that deck, they should be they should be sort of scratching their head and have the reaction of, "Gosh, yeah. Actually, now you mention it. Oh, how did I not know about this?" That's ideal. You don't want it to be so so kind of niche and specific that they just have no idea that this market even existed. So I think a really relatable problem statement to open up with is really good. So if you're talking the structure of it, you've got your title slide or whatever, but yeah, then hit me with some simple problem statement that if I walk out, whether it's a pitch or if I'm just being emailed it, if I shut the computer down, go out and bump into someone 10 minutes later in a coffee shop, I should be able to relate to them really easily what I've just read. So you wouldn't believe what I just had sent in. Like, did you know that, over like 50% of our, whatever it is, that sort of thing. You want to get that across nice and easy. So you're basically bringing the audience up to the same level. Like they should, by after that first page, have a good, okay, this is the problem out there. I know where this is going now. Don't leave them waiting for too long where they can't figure out what your business is going to do. Like, you set the problem, set your stall out nice and early. This is the problem. Then you bring in, then you start to bring in what's the solution? What have I developed that can solve this? And then move very quickly into why there's scale there. So then within 3 or 4 pages of your pitch deck, and keep it nice and visual, not lots of text, you should have covered those 3 angles. So really clear problem statement. So great, wow, that's a major problem. Second one is how you're going to solve it. Very simply put, what's your technology you've developed to address that? And then third, kind of, I suppose you call the third slide like, why do I care? Oh, right, this is a really big problem. There's a big market. And then all your usual stuff, right? Then the remaining sort of 10 or so slides, you can, you're going to get the team slide, you get the competitor slide, the good old matrix box that everyone has, all the usual stuff, bit of the financials, nice and summarized. Obviously the ask. The number of people I see that forget to put the ask in. You get to the end, you go, that's brilliant tech. I have no idea how I can help you. So yeah, put the ask in.
Yeah.
And it is those first 3 slides. And the way I describe it, in my head, the easiest way I can think about it is, think about you've been given a podium, right? There's 200 investors in the room.
Yeah.
You're standing up. You've all got 5 minutes to pitch in the next hour or something. You've got probably about 1 or 2 minutes. Well, probably not in 1 or 2 minutes. You've probably got about 30 seconds to 1 minute to lose your audience. You all know what everyone's like. Because if you lose, if they can't get the problem really quickly, they'll pick up their phone. And once they look at their phone, they'll
probably more 30 seconds.
Yeah. And the thing is, you have to accept that in that audience, if there's 200, probably 180 of them are not relevant for you. That's fine. Let them check their emails, right? They can go onto their phones and start doing work while you're pitching. But what you can't do, you can't let those other sort of, the other sort of 10% or so not quite get what you're talking about, have a little beep on the phone. And once their eyes leave you and they're checking their phone, you've lost them. Get it over quickly.
Do you advise on startups on how to value their business and how do you value?
It's like, could argue there's a slight conflict of interest there, but we do. I think because with that kind of investor, we are, we are considered fairly founder friendly, that we do have open conversations with them about it. The simplest way I say to people, look, if you're going to take one approach, but basically you're storytelling. You're talking to an audience of investors, let's say, and you're telling them a story that we hope's believable, that hope's backed up by some research and substance. And it's about a problem that this is the size of the market if we can address this problem. So we know we're playing in a big enough space, and this is how I intend to get it through to market. This is the funding that I'm going to need. And this is realistic where I think I can take this business. And if you start to build that story up and you can back it up with assumptions, and again, assumptions that you'll probably will be challenged on by investors, but some kind of assumption, you said, within the UK, there's this size of opportunity. In year 3, we're going to open up the US. That's that size opportunity. We're being cautious. We're going to go via these channels to market and all that sort of stuff. But if you've lifted those assumptions out, you've built a credible financial forecast, which is a story still. If the investor can look at it and say, oh, okay, well, so what are they saying to this? So they're saying they reckon they're worth about $1 million, let's say, pre-money. Do I think that in, say, 4 or 5 years' time, there's a good chance, based on this story, that their valuation could give me 10 times, on paper? You probably won't get the exit time, but roughly heading towards that. And I think if you can present a credible story that shows that, then based on this valuation, even if I do half of what I'm looking to do, you still get, 7 to 10 times your money in 5 years. The good thing about doing that is the investor then has to start engaging in a sensible conversation around what it is they don't believe about your story, which is good, because then if they're a smart investor, they might actually have some useful insights. And they say, oh, well, do you know, the US, because it's going to cost twice as much to open up. Like, great, okay, that's really good feedback. That nudges it all down a bit, but at least it's a sensible conversation. It's not just a kind of, I'm anchoring you on a valuation, like, 10 million. They're like, wow, maybe it's 4 million. Like, wow, should we meet in the middle? Like, that's not a sensible conversation.
No. If you were 21, and you had, 10 grand in your pocket, and you could start a business, what would it be today? What was the?
It's a tricky question, isn't it? Yeah, Gosh, that is a really tough question. Probably 10 grand wouldn't go so far. That's the thing, right? But I think I'm not sure.
100 grand. There.
Yeah, I was going to say, but the thing is, like that whole, that we talked about earlier. Like, are you born as an entrepreneur? Do you learn? There's a moment in your life where you're willing to take a certain level of risk that does change. So when I set up the fund, it's a very different profile of business that I set up when I was in my 20s. And my appetite for risk was on another level when I was in my 20s, and as you get a family, your appetite changes. But yeah, so it's really hard to think back to if I was in my 20s now. But I think I would recommend you go through the same thing, right? So let's assume that cash is a scarce resource. So whether it's 10 or 100 grand, whatever it is, get something set up, but really to understand the market and find an opportunity. Like, you basically bought yourself some time to really find something worthwhile doing that you believe in and are passionate in, that ideally brings a return. But yeah, no, I'd say if I could go back, and I suppose the question maybe if I could go back and chat to myself in my early 20s, I'd say just have but the things, you wouldn't change anything, would you? You wouldn't be where you are today. But I would say a good advice, I don't think it'd be bad advice to say, look, just take a minute. You've got yourself some freedom here. Let's just figure out that what you're doing is worthwhile, impactful. You're passionate about it all, and it's got a bit of scale to it all.
Yeah.
Spend that time researching it. Fail fast and fail fast, I suppose.
Yeah, definitely. Fail fast or fail forward is good advice. I would also agree. Entrepreneurs today versus entrepreneurs 10, 15 years ago, what's the difference? Do you see any difference? So obviously, technology and opportunities are different, but do you see a difference?
I don't think there really is. I think technology, but if you went back then 40 years, it'd be even different again, before sort of email and all that sort of thing. Now an entrepreneur setting up now, it's another, like we talked about, the cost burden can be brought down through technologies like AI for sure. That'll be a big, you can do a lot really quickly and really cheaply. But I think fundamentally the characteristics are the same. You need to be able to sort of spin a number of plates, understand a number of disciplines. You can't really be too expert in any of them. And as you scale, you need to relinquish that area of expertise, right? Even if you're passionate about it. And I don't think that really matters if within marketing you now have a very large AI team, or probably in every department, you'll have AI filtering through it. But there's different skill sets. But I think fundamentally the personality traits are the same.
Yeah,
go against the grain.
Yeah, mental health has become a lot more prominent. For whether you're male or female, for that matter. I mean, how do you recognise that? Because obviously entrepreneurs and yourself, of course, working in high stress situations. How important is this to you, and how do you support that, and how do you manage that yourself?
Yeah, it's tricky. So we could do more for sure. The mentoring program helps, because that is, we have two distinct roles that every company gets. There's the mentoring side, that's an arm around the shoulder, that's signposting, that's guidance, that's experience, and for want of a better word, that's the good cop side of it. And then you have a sort of board observer that's maybe slightly more on the bad cop side, that's kind of pinning numbers on people and saying, let's be real about this, and how much cash have you got left. So I think the mentoring side of things really helps. I think we can do more, and it's interesting, it's timely. Like we've had founders that are burnt out, and we're very mindful of it. It's not good for anybody. Any of the shareholders and the founders are very typically the majority shareholder by a long shot. So it doesn't benefit anyone to end up in that scenario. But it's so we're looking at bringing different things to our seed funds, because we recognise it's a real thing. I don't think you can't 100% mitigate founder burnout. Is how we see that's the sort of from our side of things, how we see the mental health piece play out.
Yeah,
they'll just burn out. So we're looking at moving forward, bringing in maybe an element of coaching, which is interesting. It's very distinct to mentoring. So we've always been big on mentoring, but coaching is a different discipline. It's a subtle difference, but it is much more about you as an individual. And you are. Probably the biggest thing in your life is your startup. So it all sits together and benefits the startup. It's like you said, it's super stressful.
Yeah, I think the coaching thing is a great approach, and I think when you are an entrepreneur like this, you're under many stresses, but also the kind of perception of I must be doing all of these hours. It doesn't help when you see these people, they'll call successful. and they're giving this kind of perception that you got to be sleeping under your desk, and you got to be doing whatever 100 hours, and all this kind of stuff.
Recognise there's periods, right? There's periods where there will be pinch points where you do just go way above and beyond what a normal corporate staff would do, but you have to take your foot off the pedal. You've got to take a break. You've got to switch off. It's not, we hear some of them as like, it's uncool to put out an office on. I'm like, mate, it's August. You got 2 weeks with your family. Putting out an office on. Yeah, we'll survive. It's okay. Yeah. We'd rather you're in a fit shape come September.
Yeah. Well, Damon, thank you very much for your time, of course, and your insights. I think the work that you're doing at British Design Fund is very commendable because, as we've discussed, it's not easy, working in bringing physical products to market. There's risk, but I think as long as there's people like yourself and the British Design Fund and of course the ecosystem around that, as you've described, then I think the future of hardware and physical products is in good hands, especially in the UK. We have fantastic resources and capabilities here, and I do think that the future is bright and that we can use and implement technology for the good and hopefully make the world a better place. So thank you very much. And again, really enjoyed spending time with you.
Thanks.
Thank you very much. Take care. Thanks. All right.
Great.
That's a wrap.